Hello, welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone, easy for me to say, Senior Market Strategist Michael Brown. How are you, Michael?
Very good afternoon to you, mate. I'm all right. It's been another, exciting, interesting, tiring week in the financial markets.
Oh, big week for central banks.
Yes.
Fairly muted response, I think, on the part of the markets to all the decisions, and we'll talk about them in a minute. But before we get started, there's something I really need to get off my chest. I'd like to make a statement about an item that has come to my attention this week on social media, and it's come from a variety of sources. It's about some deep fake AI videos purporting to be from me inviting people to invest in an online investment club via WhatsApp. Suffice to say, I'm seething about this. Anyway, this is my statement. Using scraped videos of this podcast, an AI representation of my voice has been used to encourage people to put their money into a non-existent portfolio of stocks and shares. I would like to stress in no uncertain terms that this or any other online offering has nothing to do with me. It is a scam. I don't and never have or will offer investment advice or ask for money on WhatsApp or any other messaging service. Furthermore, we at the Good Money Guide reported these posts to Meta 24 hours ago, and yet they are still visible and being viewed. To my mind, this gives the lie to claims by Meta that they want to prevent these types of scams happening. As a signatory, they are a signatory to stopscamsuk.org.uk. You would think, as a signatory to this, they would be proactive in stopping this type of thing happening, yet they are actively taking money from fraudsters in the form of sponsored posts and promoting these posts that are clearly fake. Knowing this, I am exploring a number of options in respect to allowing this fraudulent misrepresentation to go ahead in my name, as well as in the name of the Good Money Guide. Now, that's all I have to say now on the matter, but I will keep you posted. But suffice to say, I am seething. Anyway, it's risk warning time, just to give me time to cool down a little bit.
On to something happier.
Yeah, that's saying something. That's a low bar. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 75.9% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so where should we start, Michael? Do you want to go while I just slowly?
Well, yeah. Where shall we start? It's been a busy old week in terms of
central banks. We've had
central banks.
I think we've had one rate cut this week, and that was from the Swiss National Bank.
We have, yeah. So we've had 5 policy decisions across G10. You're absolutely right in saying that the Swiss National Bank, the only ones to deliver anything in terms of a rate adjustment, lowering rates by 25 basis points early this morning on Thursday. I guess the big ones, of course, that our listeners will be focused primarily on is firstly the Bank of England, who held bank rates steady at 4.5% in an 8-1 vote. And then, of course, the FOMC, who who also held rates steady in a unanimous vote at their decision on Wednesday evening. And I guess the biggest takeaway from all of this, and we can get into the specifics of it in a short while, for me, mate, is more that actually, and it's kind of refreshing, central bankers have got as little clue and conviction about the economic outlook as the rest of us. And as a result, they find themselves almost stuck in this inertia of effectively not being able to make any policy adjustments until they have substantially greater clarity on what's going to happen next.
Yeah, and I think this is the point. I was having a discussion on LinkedIn earlier today with a friend of both of ours, Harry, and he was arguing that the Bank of England should cut rates immediately. And I sort of pushed back on that and sort of say it's not the Bank of England's job to basically get the government out of get the government out of trouble, because ultimately an awful lot of the problems that the UK economy is suffering from right now are very much homegrown when it comes to headline inflation and wage growth.
Mm. Yeah, absolutely. And of course, the Bank of England's mandate is, and I think we had this conversation after the February MPC, the Bank of England's mandate is to ensure price stability, which is taken as inflation at 2% over the medium term. That takes precedence to everything else. Their mandate is not, when the government are inept, throw the inflation target aside and cut rates to try and bail them out. That is not how the Bank of England operate, nor is it how the Bank of England should operate, may I add, because if they were to start going down that path, then you're very, very quickly eroding what little credibility you have left.
Yeah, and there's another point to that, and it was a point that I made to him, was that we've seen 3 rate cuts since August, and the UK 5-year gilt yield is higher now than it was then. So what good would a 25 basis point rate cut do? Because ultimately that's not what mortgage rates are priced off, or any other borrowing costs are priced off anymore.
No, not at all. And actually, you're right. Swaps have moved quite considerably higher. Both the 2 and the 5-year swap have moved sort of 50 basis points or so higher compared to when that first cut was delivered in August. And that is a result of, yes, there has been a global weakening in terms of fixed income, but it's also a result of the market pricing a greater risk premium around the UK economy as a result of the perilous fiscal position that we're in. And I'm sure our beloved Chancellor will be delivering a pleasing update on that front next Wednesday.
Yes, indeed. And on that topic of the spring statement, I'm getting slightly ahead of the game on this. We will have a special guest coming on the podcast.
Oh, I wasn't aware we were allowed to talk
next
about
week.
That, but yes, we will. I'm very excited about this.
No, we are. I'm not going to mention his name quite yet, but he used to be a Bank of England policymaker. He's well known on Twitter, and he has very kindly agreed to come on and talk to us not only about the Bank of England, but also about the spring statement. And it will be a pleasure to have him on. And I'll tell you who it is later in the podcast. So obviously that's the Bank of England. Federal Reserve have their own set of problems. They upgraded their inflation forecast yesterday, and downgraded their growth forecast, and incurred the displeasure of our friend in the White House by not cutting rates.
Well, I think they were always going to incur his particular displeasure. I think the only surprise in that one was it took him about 12 hours to voice that displeasure. He was clearly busy doing something else. I thought the Fed, to be honest with you, that again springing no surprises yesterday. We knew that they're going to revise their inflation projections higher and growth lower. I did think it was quite interesting that Chair Powell tried as hard as he possibly could to distance the committee from those projections, which again is not particularly surprising. The degree of uncertainty in terms of the economic outlook is huge. And I think the Fed are very much in a position where they know that there's this huge degree of prevailing uncertainty out there. The last thing they want to be doing is adding to that by, muddying the waters even more. So I think it's very much a case for the Fed at the moment of, yes, they have to put out new projections. They have to put out a dot plot. That's how they operate. But besides that, I think they're going to want to be as quiet as possible and almost as incognito as possible for the next 6 weeks or so, because, as I said a moment ago, they, like everyone else, are just desperately hunting around for a little bit of clarity as to not only what's going on at the moment, but also what might happen next. And until we get that, it's tough to really have any conviction behind any sort of economic forecast whatsoever.
Yeah, sort of. I think Powell yesterday didn't step on any landmines. Interesting that he wheeled out transitory
Oh,
again.
yeah.
That
I
old
was very
that old
surprised
central bank
about that.
chestnut of transitory. I mean, I thought that had died a death and was being replaced by hump in inflation, which is what Andrew Bailey was talking about earlier this year. I think the Fed. I think the Fed wants to give the impression of. Have you seen that meme with Homer Simpson basically retreating back into
Into
the
the
hedge?
hedge, yeah.
I think that's what the Fed and central banks in general really, I think, want to be like. I think in terms
Hmm.
of. And until next month, essentially, I think for the Federal Reserve, it's what effect are these reciprocal tariffs
Yeah.
likely to have on the inflation picture? And here in the UK, there's an element of that, but there's also the impact of various council tax rises, utility bill
Hmm.
rises, and obviously changes in business rates, minimum wage, and national insurance thresholds, and what effect they're going to have. And I think against that backdrop, I don't think the Bank of England could cut rates or the Federal Reserve because
No.
ultimately there's just so many unknowns, unknown unknowns, and known unknowns,
Yeah, you're
to coin a
absolutely right.
phrase.
And yeah, in terms of the Fed in particular, I thought the use of the word transitory last night was very surprising. Maybe Powell's going to be right, and I certainly
Mm,
hope he is.
mm.
But the negative connotations that are associated with that from 2021, I thought he would do a bit more of a better job of avoiding repeating that.
Mm.
I think the big question that the Fed are going to be trying to answer is, to use the analogy you used, is this an inflationary hump, or is it going to be more prolonged? Because it's all well and good saying, reciprocal tariffs go in on the 2nd of April at whatever level they may go in at, and they cause prices to rise by X% over the first 6 months of their imposition. Fine, great, we all get that. The bigger question is, what is the sort of more medium and longer run economic effect of those tariffs? If we, for instance, start to see US manufacturers beginning to reshore production, well, the cost of producing something in the United States is a hell of a lot higher than it is to produce that in the Far East, for example. The same goes for labor costs. They are a hell of a lot higher in the US than they are in other parts of the world. So that's when you start to think about what central bankers would call the second round inflation effects of the tariffs that are coming in. And I think that's one of the reasons why we see the Fed in particular continuing to err on the side of caution, because not only are they trying to model the tariffs themselves, they're also then trying to second guess how businesses in the United States will adjust to and react to those measures once they're imposed. And I think actually if from a risk management perspective, if you're sat there on the FOMC, there is very, very little cost when inflation is at 2.5% and the labour market is at full employment. There's very little cost to going, actually, we're just going to wait another quarter or two before we do anything because we want to see more data.
Yeah, on that topic of reshoring and obviously US capital or US employment, cost of production being more expensive. Did you see that headline from Nvidia's CEO, Jensen Huang, who basically said they're going to spend hundreds of billions of
In the
dollars,
FT.
yeah, on US manufacturing, and yet
Yeah.
the share price is up today. I mean, that's surely going to shave, a few percentage points off their 70 odd percent operating margins, and yet the
You would
shares are
certainly
higher.
expect so.
Yeah,
Yeah.
so
And also,
it's an
you then
interesting one. That.
consider. Yeah, and you then consider, if Nvidia are doing it,
Mm,
then who else, not only in that sector but in the economy at large, are going to end up following suit? Because I
mm.
think, to be fair to them, we talk a lot about how policy making is incoherent and volatile. Actually, one of the things that the Trump administration has been very clear about is, if you do things overseas and bring them into the States, you will pay a tariff. If you do them in the US, you will not pay a tariff.
Mm.
And that's basically the choice that the businesses have got at the moment.
Be interesting to see whether or not US actually has the skill set
Well, this is
to
the
be
other
able
thing,
to
isn't
do
it?
this.
Yeah, it's all well and good saying, reshore production,
Yeah.
bring everything back to the States, but, are there the folk in the US, as you say, who have the necessary knowledge and skills that's been, worked on for decades in other parts of the world. You can't just suddenly bring that, transplant all of that into the United States. I doubt that is possible without some pretty sizable bumps in the road.
Well, you have to spend an awful lot of money on what I would call upskilling these sorts of people to be able to deliver the same quality that ultimately people will demand from, in particular, if we're talking about chipsets, which are very sophisticated. I mean, obviously, most of it's probably automated anyway, but you still got to get the plant and machinery in place. You've got to get it installed. You've got to make sure that the supply chain works properly. There's an awful lot of upfront cost to that.
No, absolutely. And it's another one of those policies that on paper, or, when you see the obsequious Howard Lutnick on television going, more jobs for American workers, well, great, it sounds brilliant. Everyone's going to say that's a good idea. But actually putting that into practice is a lot easier said than done.
Yeah, and as I say, I mean, once you lose a manufacturing skill set, it's very difficult to then build it back up and re-engineer it back up. And that's the problem that we've got. We've got a similar problem in the UK. And, as a result of globalization, we offshored everything. And now we have a manufacturing base that, while it's very, very small and very, very focused, I think we'd struggle to expand it significantly in a short space of time. It's going to require a government, which has long-term thinking in mind. And unfortunately, politicians these days of both sides of the political divide, I think of about the attention span of a goldfish.
I think you may be being a little bit harsh on goldfish there, to be completely honest with you.
Probably. But I mean, irrespective of, our views on this, I think markets have taken the decisions this week pretty much in their stride. I'm looking at the FTSE 100. It's down slightly today, but we've seen a modest rebound off the 1 month lows that we saw last week. And actually the DAX retested the record highs earlier this week. Oh yeah, it's down today. It's actually down quite considerably today. But overall, I think the markets are taking it in their stride, and US markets are just. I'm looking at the S&P now. It's modestly high. It's back above 5,700. So that's an interesting one.
Yeah, I mean, I don't want to, tempt fate or be a jinx or anything here, but it does feel like we've had a little bit of in terms of price action at least, just a little bit of a calmer week for financial markets. I think naturally focus has turned to all of these policy decisions, the BOJ, the SNB and the Riksbank in the mix, as well as a few in EM in addition to that. And I think also the news flow around tariffs has been considerably lighter this week than it has been of late. I mean, I think the most significant tariff announcement that we've had recently came last Thursday, actually just before we sat down last week, which was the 200% on European alcohol. Since then, it has been a little bit quieter on that front. And I think, this week has almost been a welcome return to a modicum of normality for market participants to go, let's get our teeth into some policy decisions and almost see what the grown-ups have got to say at these central banks. But fundamentally, that doesn't change the outlook. We are still, about 10 days or so away from the 2nd of April, when these reciprocal tariffs are supposed to come in. We're still dealing with, ongoing worries over the US economy continuing to lose momentum. Those have not gone away, despite the fact that markets are sort of plodding along in relatively solid fashion this week.
Yeah, certainly I think J.P.L. seemed fairly relaxed about the state of the US economy, seeing no reason to, panic. Yeah, we've seen weekly jobless claims, they're still fairly steady and around the mid-220s. Non-farm payrolls recently, there's nothing overly concerning there. And I think it's a similar story here in the UK as well. Unemployment, 4.4%. Yeah, wage growth slowed modestly. For the 3 months, but it's still only just below 6%, and actually private sector wage growth actually ticked higher. So again, there's nothing at the moment to suggest that we're on the cusp of a significant slowdown, certainly in terms of the labour market. It's just the broader economic numbers and obviously what's coming down the pipe that I think an awful lot of people are concerned about. So let's say the next 2 or 3 months should be interesting.
It is going to be interesting, although having said that, I wouldn't be surprised if, on a sort of global level, we don't end up slipping in, providing Trump doesn't say anything stupid, we don't end up slipping into a little bit of a lull. I was looking at the economic calendar for next week earlier, and I know we'll discuss that in a while.
Yeah.
But it is a little bit barren in terms of top tier events, at least. I mean, you're really now looking towards that tariff deadline on the 2nd, and then the next jobs report out of the States on the first Friday of April as the next kind of significant data catalysts for markets to get their teeth into. And then about a week after that, we roll into the start of Q1 earnings season stateside, which I think is going to be very interesting indeed, because it's the first time we'll have heard from these firms around, how they're adapting to this current uncertain environment.
Yeah, starting with the banks, obviously. JP
As
Morgan,
always.
Goldman Sachs, as always. I can remember when it used to be Alcoa. Not anymore. Anyway, yeah, it's also been a quieter week for the dollar as well. Seen a little bit of a modest rebound. Those two key levels on cable and euro dollar held up fairly well, 109.50 and 130.20.
Yeah, rather annoyingly so.
Well, for you, maybe.
I was 47 pips away from a free lunch, and now we're back at 108.
Yeah. There you go. Well, that's your range, isn't it? I was parity, you were 110, and we're basically stuck in the middle there. A bit of a Steelers wheel vibe there.
Yeah.
Anyway, so yeah, and gold's a little bit softer as well, though not massively. It's now above $3,000 an ounce. So on the dollar front, I think it's pretty much as you were in a bit of a range trade, I think.
Yeah, I think so. And again, I just think that speaks to the fact that, these moves, whether it be in the precious metals complex, whether it be in the euro, whether it be in the quid, they've come a very long way in a very short space of time. I mean, you look at euro dollar, we started the month at what, 103, 104, something like that.
Yeah.
And then as you rightly said, we shot up to 109.5 in the space of about 2.5 weeks.
Yeah.
And I think particularly in the case of the euro, this week was a good example. Actually, we saw the German Parliament pass the defence and infrastructure spending package, and actually the euro ended Tuesday when they passed that. The euro ended the day in the red. Classic sort of buy the rumour, sell the fact trade going on there, but I think it just again speaks to the idea that the common currency's probably priced in a lot of good news, and for it to push higher, or indeed for the dollar to push lower, we're probably going to need another catalyst.
Yeah, I mean, and on the subject of, sort of buy the rumour, sell the facts, defence stocks have had a bit of a pullback as well. And I think you were saying to me beforehand, FTSE 100, it's due a bit of a reval. And apparently Babcock is heading into the FTSE. Is that right, or did I mishear you?
Well, no, that is absolutely correct, according to the Bloomberg headline that I sent you on WhatsApp yesterday.
Yeah.
Although the interesting thing is, whoever wrote that headline didn't tell me who they're replacing. So if anyone knows, answers on a postcard, please. But nonetheless, Babcock going in the FTSE. And, again, even though defence stocks have had this little bit of a pullback, it's still, over the medium term, very, very tough to bet against the sector, in my view.
Unless you happen to be QinetiQ, whose shares have absolutely tanked from the highs that they were at the beginning of the month, 530p. They're now back down at 370p. Issued a profits warning on Monday. Fell 20%, continuing to fall. They took an impairment charge of about £140 million for this year because of the market backdrop and operational performance in the US. It also flagged a number of one-off exceptional charges of £35 to £40 million, largely non-cash related to some of its US operations. It warned that full-year growth will be lower than expected amid contract delays and difficult trading conditions. So, basically those shares are back below or near to the lows of the last 12 months. So, it just goes to show that, one profit warning in these sorts of markets can undermine the bull case for any particular company. I think the big question I'm looking at is does it change the outlook when it comes to the amount of business that countries are likely to do with QinetiQ? And I would argue it probably doesn't. So
No, I would say it probably doesn't either. I think it just speaks to how fickle the market is at the moment. Well, market's fickle at the best of times, but certainly in this sort of an environment, and also how difficult it is to have a strong degree of conviction. The market is not going to be, whether it be a firm issuing profits warnings, earnings misses, soft economic data, whatever it may be. The market is not in a position where it's going to be particularly forgiving towards any of that, I don't think, at the moment.
And it sort of goes back to what we were saying beforehand. Basically, if you're investing in companies, defense companies and what have you, you're not investing for the next 3 to 4 weeks, 5 weeks, 6 weeks.
No, absolutely not.
You're investing for the next 6 months, 1 year, 2 years, 3 years and 5 years. And you're going to get these periods of volatility, sharp falls, followed by slow rebounds back. It's par for the course. Stock market investing is very much a long-term process. It's not
exactly.
It's not
also,
something,
Well, no, sorry, I was going to say that's also why we constantly harp on about the need for balanced portfolios.
Yeah, absolutely.
In an attempt to smooth out a degree of that volatility. But as you say, although generally over time equities will move higher, it's not going to move higher in a straight line.
No, and certainly I would argue that what we're seeing with respect to QinetiQ is very much the exception rather than the rule. If you also look at Chemring. Chemring shares were, were subject to a bid last month, I think it was, from Bain. Those shares have now drifted back down from their peaks of mid-February, just above 420p, and they're now back below 380p. So, maybe Bain aren't coming back for another bid. Who knows? Yeah. But ultimately, it doesn't undermine the long-term potential for these types of companies in this new era to do well and get lots of new business from various different governments.
Exactly that.
Okay, going to have a quick look back at the results that we previewed last week. Sadly, the pool of those results has got very, very small because Travis Perkins delayed their results. And at the moment, there's no clear indication as to whether or not or when they're going to publish them. I checked the website just before we came on, and they've got the date for their Q1 update, but they still haven't got the date for the full year results of 2024. So I guess we're just going to have to wait and see, but the market was very unforgiving on the back of that and basically sent the shares to sharply lower.
Which is... Sorry, just to say, which is not particularly surprising because whatever the reason is behind them delaying the results, it's never a particularly good sign when a company does that, no matter what industry they may be in. And it leads, particularly when the only word you get is results delayed, we will release them ASAP. It naturally leads market participants to price in the worst possible case scenario. It's not a case of everyone's just going to go, oh, okay, that's fine. We'll look at those whenever you want to push the button and send them out. All of a sudden you've got a huge chunk of downside risk and unknown priced into the stock.
Especially on the day in question. At the end of the day, you must have known 2 or 3 days before.
You don't just wake up that morning and go, I actually don't fancy it anymore.
Yeah. You must have known 3 or 4 days before that you were going to have to delay the results. Get out in front of it.
Yeah.
Get out in front of it. You'll still have a share price reaction, but waiting until the day that they're due to be released. So, well, actually, they're not ready. Release them a day late, release them a week late, but don't just say, oh, they're delayed on the day in question, because the fact that you
not give a date,
and not give a date, exactly. Wickes, on the other hand, which was spun out of Travis Perkins, is one of the best performers today. It's up 6%. As we suspected. We did see a fall in profits, 23.6% to £23.2 million. But revenues fell 1%. But the biggest reason for the decline in those full year revenues was down to a 10% decline in design and installation. So essentially big ticket items like kitchens and bathrooms. People aren't paying up to have major refurbishment work done within their house. On the actual retail side, revenues were up. So actually the broader, wider business is actually holding up fairly well. I think when you consider that Homebase collapsed, Carpetright collapsed, I think the market has become much more what I would call condensed and tight. So you've got the bigger players doing better, and obviously on that note, we've got Kingfisher out next week, B&Q, Screwfix. It'll be interesting to see, what they come out with next week. But as I say, we'll talk about that in a minute. And obviously we've got JD Witherspoon out tomorrow. So and we've got Nike and FedEx due out tonight or Thursday night, because by the time this goes out, it'll be probably Friday morning. So there'll be no puns today.
Well, not about that anyway. I can't promise anything else.
Not about on any of that. Anyway, so that sort of brings us to a conclusion of this week's event. So you talked about, next week being fairly data light when it comes to macro, but we've got a big UK calendar.
Here in the UK it is very busy.
Got 6 more sleeps until the spring statement. So
actually, just on that, I would love to have a word with whoever in the Treasury or Number 10 decided on the date for the spring statement, sandwiched between 2 gilt auctions and 5 hours after the latest inflation numbers. I mean, what are they thinking?
Or maybe was it the Treasury, or would it have been Rachel? Would she have had a? I mean, I suppose it would be the Treasury, wouldn't it?
Yeah, it must be.
Or
the civil servants.
Or maybe it's a case of the Treasury not talking to the Debt Management Office.
Yeah, the left hand certainly not talking to the right either.
Oh, but that's true of the civil service all over. my partner, she used to work in the Home Office, and Home Office. There's departmental rivalries and akimbo going on in the civil service, from what she was telling me. She's retired now, so it doesn't matter.
Yeah. But either way, someone needs to have a look at the calendar before they book these things in the diary.
Well, you would think so, wouldn't you? Okay, so we've talked about wages today. Obviously, the unemployment outlook, nothing too serious to worry about there at the moment. UK inflation. Now, I don't think I need to remind you, it was 1.7% in September last year, and now it's 3%.
And it's only going to go higher.
So why would the Bank of England cut rates?
And actually, even if you ignore the headline inflation metric, which has got a lot of skew in there from things like energy prices, we're still dealing with core inflation north of 3%, and we're still dealing with services inflation at 5%. Again, both of which are likely to continue to move higher. So, there's not really... And again, it's too early for any consensus for next week's figures just yet.
No.
But again, I certainly don't think there's going to be anything in there that would make the bank either regret the decision to hold rates steady today, or equally that would give them any sort of a nudge or an urge to ease policy quicker as we move through, the next couple of quarters. I think it's very much going to be a case of headline inflation continuing to move higher and the underlying inflation metrics remaining annoyingly and stubbornly elevated.
Yeah, I mean, I'm looking at core prices. They jumped from 3.2% to 3.7% in January. We haven't even got the latest April pay, the latest April numbers coming through. Council tax up 5%. My broadband subscription, TV and what have you, has gone up. They say an average of 6.2%. Well, mine's higher, so 7 or 8%. And that's before you even include rail fares, which are also going up in April. I mean, airline fares was one of the big components that drove headline inflation up in January. Obviously, that'll drop out of the February numbers. But
again, it's just on that. I mean, this has been a bit of a bugbear of mine for a while. And I understand why we do it. We try and explain away the data being skewed by one or two factors. But for the last 18 months, we've had a varying range of one-off factors that have been pushing the number higher. It gets to a point where you've got to say, actually, let's just look at the number itself. Here it is, and it's moving in the wrong bloody direction.
Actually, here's something, and I think this is a good time to basically tell everyone who our special guest is for next week.
Go on.
I was driving earlier this week in my car, and they're changing the inflation basket to include virtual reality headsets. Why? Who can afford to buy a virtual reality headset, for crying out loud? It's very much a discretionary item. It bears no relation whatsoever to the cost of living.
I didn't know they were doing that.
Well,
That's news to me,
I heard it on the
actually.
radio. I heard it on the radio, and I went and I looked at Ruth next to me. What? You know,
How on earth are they justifying that?
yeah. So anyway, I'm going to talk to Andrew Sentence about this next week, because Andrew Sentence, ex-MPC, external MPC policymaker, has agreed to come on and talk to us about central banking, how essentially, look behind the curtain, if you like, of the MPC meetings and give us his viewpoint on how difficult it is for central banks to set rate policy. Also, I think talking about the various measures that we use to plot inflation and whether or not they're fit for purpose. CPI, CPIH, RPI, PPI, all of those different measures, and hopefully pick his brains and trying to get some sort of consensus about all these economic terms like R squared, R starred, the Phillips curve, and essentially I think try and make sense of it all. So I'm really looking forward to that, and also give us his view on the spring statement, which will we'll segue into that right now. I mean, can Rachel make things anywhere? Can Rachel make things
have to
any better or worse? I mean, why are you having a spring statement when your tax measures from October haven't even kicked in yet?
Well, that is a very good point, and I think the first thing to sort of frame the events of next Wednesday is to say that the government and Rachel Reeves, when she was put in as Chancellor, said we are going to hold one major fiscal event a year, and that will be a budget in the autumn, which, to be fair, is a very, very sensible way to conduct fiscal policy. These are not things where you can sign something and with the stroke of a pen things change overnight, at least not in terms of the overall effects of those being filtered through to the broader economy. So the spring statement was always meant to be just that, an update on the OBR's projections and a review of government departmental spending over the following years. The issue is that the fiscal situation has become so precarious since the budget that the spring statement has morphed into a major fiscal event. And that's because the UK's economic growth has been utterly anemic since last October. And also, of course, gilts have sold off across the curve and yields have risen, which in turn have both eroded the Chancellor's fiscal headroom, the 9 billion quid that she left herself last October. So I think that's important to remember, that the only reason this is actually something that we really care about and is going to be a major event is because of how terrible the situation has become. Now, what I think is interesting, and again, you always get so many sort of trial balloons in the run-up to these events, but the latest reporting is that Reeves is not going to be changing anything to do with tax, and this will all be a focus on spend. And obviously spend is only going to go in one direction given the rather perilous fiscal backdrop. So the question that's on my mind, and I'm sure it's on yours as well, mate, is can she deliver spending cuts to such a degree that, one, balance the books, but that, two, don't just tip the economy over the edge of the cliff that it's currently sat right on the edge of?
Yeah, I mean, when you look at the size of the public sector, it's at a 13-year high and it's not productive, and it hasn't been productive since 2001, the public sector. And ultimately, I think the Prime Minister announced the abolition of NHS England. Fine, okay, don't have a problem with that, as long as the money saved goes into actually the frontline NHS services, which I think require it. I think
absolutely
an awful lot of public services are too management heavy, and they need to much be focused at the sharp end, where the staff are quite clearly struggling. But it needs to go deeper than that. It needs to go to GPs. I mean, I still haven't seen my GP, and I've been living down here nearly 3 or 4 years. I can't get an appointment with a GP. Don't even know who my GP is. And if I do want to see my GP, it's usually, it's an emergency. Well, no, if it's an emergency, I go to A&E, but I don't want to go to A&E.
I'll see you in 4 weeks' time, by which point you'll probably be healed again.
Well, exactly. But I wouldn't call the doctor for anything like that. Anyway, slightly off topic. I think it's really a question of how much money are they looking to cut, and where are they going to cut it? Because I think you can make spending cuts to certain unproductive areas of the public sector. But since the new government came in, they've announced all manner of new quangos and public bodies to oversee certain hobby horses. So she had fiscal headroom of £9-10 billion. So she needs to make savings to that amount or more for her spring statement to stack up.
Yeah, and I would say it actually needs to be more than that, because obviously we saw how easily that was eroded last time out. So I mean, even a margin of 20 billion is pretty tight in fiscal terms. We're talking about running a country here, for goodness sake. The one thing I would say is, obviously,
you could argue that could send the economy into recession. Now, I don't buy that. We're already pretty much there.
Well, exactly. At this point, the economy is growing by a tenth or two a quarter at most. If we shrink by a tenth or two, no one's going to notice it.
No.
I really
obviously the people who lose their jobs will notice it, but
at the grand level, I don't think that'd be noticed. But what I would say is, I think that this is a tightrope that Rachel Reeves is walking, and it's a very, very delicate balance, because her credibility in the eyes of market participants has been eroded very, very significantly indeed over the last 6 months, to put it politely.
I think you're being very kind.
I'm trying to be diplomatic over here. It's taking a lot of effort. But it has been eroded very, very significantly indeed, and she needs to restore that credibility. Now, trying to do so by promising spending cuts is going to be a lot harder than trying to do so by showing that she wants to raise more revenue, particularly given her political allegiances. I don't want to get political, but it's pretty well known that a Labour government doesn't really ever end up cutting public expenditure or the size of the state. So I think it's very much a case of Reeves is going to that dispatch box with a wing and a prayer and a promise that she's going to cut spending, and then going to keep everything crossed that markets believe it. And to be honest, I'm not sure market participants will.
Yeah, unfortunately, in the last 20, 30 years, very few governments have basically left the public sector smaller than they did when they left it. So, I don't think this is just a Labour issue. I think it's a broader uniparty issue, if you like, if I can use that tautology, whatever you want to call it.
You're bringing out the fancy words now. That's a cue to move on.
Yeah, we've also got UK retail sales next week as well, but I think that's on Friday. And we did see a modest rebound of 1.7% in January. It's not a modest rebound.
I was going to say, where's the modest coming from?
It's a strong rebound, but it's well overdue because it's the first positive number since August.
Yeah, and of course, as you rightly say, we were coming off an incredibly low base, which probably flattered those figures somewhat. So, I wouldn't go expecting that every month, that's for sure.
And we've also got flash PMIs from the UK and the rest of Europe, France and Germany. Again, they're not really expected to make for particularly pleasant reading, certainly not on the manufacturing side. Probably on the services side, which at the moment is pretty much supporting economic activity, not only here in the UK, but also in Germany and France. Though it was interesting to note that services activity in France slid even further below 50 to, I think it was around about 46.9 from 48.3. So clearly struggling there.
Yeah.
Okay, on the companies front, we've got Kingfisher, B&Q, Screwfix, full-year numbers. Not really expecting too many surprises from Kingfisher. They've already issued guidance to the effect that profits are likely to come in between 510 million and 540 million pounds. The shares have broken higher today, actually, hit the highest levels since beginning of December, when they dropped sharply. I think that was in the aftermath of their previous trading statement. So they're slowly recovering that ground. So it'll be interesting to see whether or not they have a more upbeat trading statement than they did the last time. The UK budget costs there, they said the UK cost base is expected to be £31 million higher as a result of the budget changes. And French budget as well was a double whammy for them.
Oh, yeah, of course.
Tax changes there are expected to cost them an extra £14 million before any mitigation. So total of £45 million in extra costs in both their French and German markets. And the French market is an absolute car crash. if I may say. Their Castorama business and the Brico business have shown sharp declines in like-for-like sales. So I really don't see the rationale for even keeping that business. They should get shot of it.
Oh, there we go. Get you in as a consultant.
Anyway, we've also got Fevertree. Hopefully their shares will fizz higher.
Oh, God. These are getting worse every week. I've just got images of you sat there at your little desk of a Thursday morning with your notepad, scribbling down these puns. I mean, that's the worst thing. I think you're scripting them now as well. Oh, no, I mean, chuckling away to yourself.
I am chuckling away to myself. But I tell you what, this is very much a British success story, irrespective of where the shares are now. Because I remember covering this when it IPO'd back in the day in November 2014. And it IPO'd at 134p a share. The shares are now 736p. But obviously they're down quite sharply from their peaks all the way back in 2018 when they're around about £40.
Let's see if the earnings give them the tonic they need to recover.
Well, there you go. Oh.
We're back in action.
Boom, boom. But joking aside, I think this is your typical IPO stock. It was valued at a very modest £154 million when it IPO'd. It became a £1 billion company. It's now worth around about 154 million. But its margins at the time were very, very high. And they've gone, we're talking mid 50%, and now they're around about 34, 35%. So there was always downside risk, especially when your share price has gone from 134p to £40.
40 odd quid, yeah.
Yeah, and now it's back down below £10 at £7.40. So much more realistic valuation. They've had their problems, but ultimately I think, looking at them, they're at the lows for where they've been over the past few years. Maybe there is potential for upside. Difficult to say. The drinks market can be a very difficult market. And, when you're taking on the likes of Diageo and obviously companies like that who've got a much more diverse product base.
And when you're positioning yourself at the top end of that space as well, as you say, it's not only a relatively niche product, it's also a sort of premium niche product as well, which won't help.
No. But they did sign a deal with Molson in January, who acquired an 8.5% stake in the company with the proceeds of 71 million returned to shareholders last month in the form of a share buyback. So, they are making some very good strategic moves when it comes to basically working with other businesses. So be interesting to see what they have to say when it comes to their expectations for the new fiscal year. Going to wrap up with GameStop's fourth quarter numbers. I'll always mention GameStop because of obviously the meme stock trade. That's been pretty uninspiring over the course of the past 3 months, trading in a range between $20 and $30 pretty much. They did make a profit in Q3. They're still very much restructuring the business. They've closed loads of stores. There has been some talk that Ryan Cohen, I think who's the CEO, will be looking at selling its Canadian and French operations, which would streamline it further. Revenues have come down quite a bit. Last year Q4 saw revenues of $1.8 billion. Q3 this year saw $1 billion less than that, but they're profitable. They're starting to turn a profit. So, and having been into a GameStop store when I was in the US, their staff are very good. They're very friendly and they're very knowledgeable. So, hopefully there is a place for a sort of a game store like that, similar to Game here over here in the UK.
Yeah. Does any of that matter for the stock. I mean, it's one of those where they are, as you rightly said, the original meme stock. They were the ones that Reddit were getting all excitable about back in 2021 during the pandemic. And I still think it's very much a case of, it's admittedly not one I follow closely, but almost what that business actually does and how well it operates plays second fiddle to whatever prevailing sentiment is at the time, and arguably where the Fed funds rate is as well.
Yeah, and obviously very reliant on consumer discretionary spending. And if the US economy is starting to slow down, what's the first thing that gets cut?
Well, precisely.
Yeah. So I think the bigger question is, is it worth following anymore? I mean, I'm interested in it because it's a gaming company.
Yeah, it's right up your street.
And I like gaming. So and obviously covering it as I did back in the day, it was always one of those companies that people wanted to talk about. Probably less so now.
Yes, although interestingly, yes, the sort of hype around the name has considerably died off recently. But having said that, it's one of those where I can't remember the chap's name now, but the bloke on Twitter who came back again briefly about 6 months ago, and all of a sudden it's on the front pages. So sentiment can change very, very quickly around these sort of stocks.
Keith Gill, Roaring Kitty.
That's it. Yes, the cat. I remember Roaring the cat.
Kitty.
I couldn't remember him.
Yeah.
Horrible long greasy hair. I'm just jealous because I'm losing mine.
Well, you and me both, mate. But then again, I'm about 30 years older than you, so.
Well, yeah, I was going to say I didn't want to go down that route.
But as I say, I mean, I think I don't know. The last time we talked about this, we talked about GameStop, and I talked about. Have you seen the film Dumb Money? Because I think that's a very good summarization of how that GameStop saga played out. And it's quite an enjoyable film as well. So educational as well as actually quite enjoyable. Yeah. Anyway, that's it for this week, ladies and gentlemen. Hopefully I'll have more to tell you about the AI scam. And I look forward to talking to you all again, you, Michael, and hopefully...
I was going to say, and me.
and hopefully our special guest, Andrew Sentence, who'll be coming on to talk about the Bank of England, the UK economy, and the spring statement. So I'm really looking forward to that.
Indeed. Should be good.
All right. Lovely. All right. Well, have a great week, everybody. And we'll speak to you all same time, same place next week.